Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney, where markets have just come online.
I'm Annabelle Droulers in Hong Kong. We're counting down to Asia's major trading opens and the top stories this hour. Chinese stocks look poised for a strong open when onshore traders return from their Lunar New Year break. Investors likely to be cheered by travel and tourism data exceeding pre-COVID levels.
China's central bank keeping the interest rate on the one-year policy loan steady as it seeks to shield the yuan from volatility.
And Israel warns of a ground offensive in Gaza's Rafah area unless hostages are released by the Ramadan holiday.
And of course, it is a holiday quiet start to the week when it comes to no lead expected this week, really, until later in the week for US markets. They are closed on account of a public holiday. But this is the picture as we see trading open up across Sydney. We're looking like indicated upside of about 0.2% when we get properly into the start of cash trading here in Australia. The ASX is up by just about 0.1% at the moment. And we are still on watch when it comes to earnings. And it has been a pretty robust season driving what we see in trading today. And we did see that sort of similar theme across the US session on Friday as well, rising quarterly profit reports, seeing the S&P 500 back towards those record levels. But of course, a lot of repricing and repositioning going on given a stronger PPI as well, just sort of compounding some of those concerns over what the Fed does next after the CPI numbers came in hotter than expected last week as well. The Aussie dollar holding pretty steady at 65.33. The greenback, the longest winning streak since September. Treasury yields also rising after that strong PPI reading. So again, it is back to the sort of reining in of Fed rate cut wages. This is what we're seeing across the start of trading in the next hour across other major markets across the region. We are seeing New Zealand, where trading is already underway, a downside of about 0.5%. Chicago traded Nikkei futures are looking pretty flat at the moment. The big story, of course, we're looking ahead to is the China reopen after the Lunar New Year holidays. Bell.
Yeah, that's right. We'll have more on it in just a moment. But just to let you know how US futures are coming online here, as you said, it's that holiday start to the week, so very much flat trading at this point in time. But it is still around those expectations for profits at US companies for the next 12 months. Those are sitting at a record high, and so it tells us it's that blue sky scenario that's really being priced in at this moment, and that's what's really going to be tested. Geopolitics, it's a word, Middle East tensions, these phrases are being uttered a lot more on earnings calls, so that's really another watch as well. Oil to track. We are seeing trading in fuels, again, pretty listless here, but you've got Brent crude, WTI, just fractionally under pressure at the start of the week. But as you said, Heidi, it really is that focus on Chinese stocks on Monday because we've got onshore markets reopening after the lengthy Lunar New Year break, and data tells us that it could be a pretty bullish start because we had travel, spending during the holiday break that picked up more than expected. In fact, it actually surpassed pre-COVID levels. So let's get more now with our Chief North Asia correspondent, Stephen Engel. And Steve, yeah, what happened exactly? Catch us up over the past week.
Well, obviously, authorities have been looking for some momentum for the economy for this year. We're already halfway through the first quarter, and the numbers and the sentiment has been really weak. So there was concern that the Lunar New Year holiday would kind of be muted again as far as travel and spending, as we've seen. Granted, the last few years have been disrupted completely by COVID and then a very weak recovery last year and kind of hesitancy to travel back to their hometowns and the like. So we were still waiting to see those numbers, and they came out much better than expected. Lower expectations, obviously, but still, like you said, back to pre-pandemic levels, which is a big momentum shift, if you want to call it that, because when the Chinese consumer is mobilized, literally and figuratively, it bodes well for the broader economy as the property slump continues. The overseas FDI investment sentiment still very weak. I'll get to that in just a second. And there's just kind of a geopolitical haze, if you will, over the investment climate into China. And again, we'll talk about that in a little bit. Let's get to the numbers. Data for the travel period over the last week from about, February, what's the date today? 19th, right?
19th,
so
yeah.
until through February 17th, which is the official travel period through Saturday, 474 million trips during the Spring Festival. February 10th through 17th is the actual dates. It's 8 days, essentially 1 day more than the previous year, but still up 19% comparable period to 2019. Total tourism spending up nearly 8% to about 33 billion yuan, 633 billion yuan. That's 88, very auspicious number, 88 billion US dollars. That again from 2019 numbers, and 36% increase in railway trips, 99.5 million. So people were on the move, people were spending. But again, we have to throw that caveat out there. It doesn't necessarily offset weakness that we've seen in durable goods sales, whether it's car sales dropped off the cliff in January from December, down double digits. So again, you have to see whether this momentum continues. And I just have to add on the MLF rate, investors still looking out for interest rate cuts for the investment community is looking at that. PBOC Saturday refrained from cutting the key MLF, the medium-term lending facility rate, which is now at 2.25%. They did not cut that. They're trying to balance spurring the economy, obviously, against the weakening yuan.
Steve, the FDI numbers and certainly the direction, not particularly auspicious, right? We also have the 2 sessions coming up as well. Are we expecting sort of policy signals?
Well, we are expecting some policy signals, but so far, of course, they've refrained from doing any big bang stimulus, and they've refrained from cutting, as I just mentioned, that MLF rate, the key one. There's still other rates that they could potentially tweak. We're hearing from the PBOC-backed. Let me just see this here. The PBOC-backed financial news is saying that there could be a cut as early as this week in the 5-year loan prime rate, the LPR. That is the benchmark rate for mortgages. So when the PBOC-backed news organization like the Financial News is reporting that, there could be easing coming down the pike now that the government organs are back to work. And as rightfully said, 2 weeks to go until the National People's Congress meets in Beijing starting, March 5th or thereabouts for roughly 2 weeks. So again, we'll be looking for reading the tea leaves to see what kind of stimulus might be coming. But again, that FDI number reflects foreign confidence in China, and it is waning. FDI into China last year by foreign businesses doing business in China increased by just 33 billion US dollars, down 82% from 2022 levels. It is the lowest increase since 1993.
Bloomberg, Stephen Angle there. And speaking of reading the tea leaves, investors are desperately looking for reasons to become constructive on Chinese risk assets, right? Let's bring in Junbei Liu, who's a portfolio manager at Tribeca Investment Partners. And we've spoken to so many people in recent weeks over the Lunar New Year break who are along the lines of, we're poised to act. We're looking for a reason to be more positive. Can you see those reasons in the spending patterns, for example?
Look, absolutely. Look, this is the first of many positive signals to come, and it's probably much needed because for so long, for the last 12 months, we've all been waiting for some sort of green shoe for, investors to put money back into it. Look, I think this travel data is very strong, and that is very great sign because at the core of it, we need the Chinese consumer to start travel, to become more confident because they're the one that will start buying houses, buying cars, as well as, buying the share market there in China. So, it is incredibly important that they build confidence. And then that also goes to show then they have the confidence in the government's stimulus, then it will work. So, net, I think it's very positive, a good start. But I guess, when you talk about in general, will you pile in, put a significant investment into it? It might take some time because just in the last 12 months, we have seen so many start-stop for the Chinese economy. But definitely this is a really good start for the year, to build the confidence into that economy.
So if you're selectively going into opportunities in China, would you be looking at those consumer stocks? I know we've talked a lot about travel and leisure, the likes of Trip.com already.
Yeah, absolutely. Look, I think this is where you want to go. Looking through the history of all these other economies when they're going through reopening, it's the services you have to go into. Durable goods is going to be tough because they did buy a lot of cars, many in the last few years. So look, I think that is an area where there will be weaknesses, but services, absolutely. We talked about revenge spending across the services for every other economy. I do think that China will experience that, but maybe in a slower way because consumers are a little bit cautious. But definitely they're rebuilding that confidence in those areas.
Junbei, I'm interested, though, are there other markets that you're continuing to prefer over China instead in the region, like Japan, for instance?
Look, we do think Japan is definitely going through its structural changes, but do remember, though, it has done incredibly well and has become the beneficiary of the China weaknesses. Now, when we do see, China equity come back as well as China economy coming back, we do think that's going to be the case. That may well become the funding market for the China, the Chinese market. We do like Australian market here as well. We kind of like a low beta way or low risk way of playing the China reopening, because we do have the commodity exposure. We have a lot of our companies have trades with China. So, these are the markets a little bit more defensive. But the Japan is certainly at a risk of if China started improving.
And of course, as a China proxy, but I suppose what's interesting is that Australia's economy has idiosyncratically held up quite well, even in the face of a weakening China, or even in spite of, if you take a look at commodities prices. How's the earnings season been tracking for you here in Oz?
Yeah, look, it's actually been very good. So far, 30% of the company reported, or maybe a little bit more, including this morning. And most of the company B expectations, it's on the rate of 2 to 1 of company B expectations than miss. Net consensus analysts haven't really downgraded earnings that much, and then most of the company talked to better margin than expectations. Revenue slowing as we expect, consumer slowing down, but net things are actually not too bad, even with the guidance. So so that's tracking pretty good for us.
Junbei, we can show a graphic here, but it tells us just how many mentions we've had of the Red Sea or geopolitics, of earnings calls in the US and also Europe as well. And it tells us that there has been a big pickup. So by the halfway mark in the first quarter, the number of references to the Red Sea or geopolitics, as I said, has almost matched the total for the previous 3 months. How concerned are you about the situation there?
Look, we're definitely monitoring it, but not significantly concerned. Clearly, for the companies directly sort of have shipping rates across those routes will be more skewed in terms of impact. But net, it's not as bad yet. I know there's a lot of company talk about it. Right now, the reason it's not as bad as the supply disruption a few years ago is because the demand is not that strong at the moment. Maybe if China comes back very quickly, suddenly we see all these huge surge in the e-commerce demand, then then we might have more spike in the shipping rate. But so far, what we have spoken to, what we have heard from the companies we've spoken to, some of them already saying some of the forward rates is already falling somewhat. So look, we'll continue to monitor the situation, but it's yet to be that material.
That was Junbei Liu, Portfolio Manager at Tribeca Investment Partners there. And taking a look at what else we're watching in the week ahead, we'll get Fed and RBA meeting minutes, as well as central bank decisions out of Indonesia and South Korea. Bloomberg Intelligence expects both central banks to stay on hold, while Japan will also release more economic data after slipping into recession. Other reports to note are inflation numbers out of South Korea and Singapore, and Thailand's GDP print. It's also a busy week for earnings. We've got Nvidia reporting on Wednesday amid high expectations. Investors as well keeping an eye on how well it can keep capturing the growth for AI. Revenue is expected to more than triple for a second straight quarter. Other earnings we're watching are those from Australian miners, as well as travel and banking giants. And that's your week ahead.
Well, coming up next, Israel warns of a ground offensive in Gaza's Rafah area unless Hamas releases hostages by the Ramadan holiday in March. This is Bloomberg. Israel says it will launch a ground offensive in the Rafah area of Gaza unless the hostages still held by Hamas are released by the Ramadan holiday in March. Bloomberg's Michael Heath joins us now. So we've got sort of the outlines of this deadline, I guess, as we see kind of sputtering ceasefire talks and growing condemnation, warning against operations in this area.
Yeah, I mean, look, it strikes me as a fairly sensible move by Israel of sort of putting the pressure back onto Hamas in a way. I mean, and it's interesting, it came from Benny Gantz, who's actually an opposition leader. In Israel. When they're at war, usually the opposition will join the government for the sort of military cabinet, and he's actually tipped, or the polls show he's actually who Israel wants as its next Prime Minister. So the fact that he's come out and perhaps has a bit more bipartisan support and said this is quite telling and quite interesting. And you know, Ramadan, keeping the war going on then is going to create all sorts of problems. So I think, you know, giving them some sort of deadline, pledging to work with the US and other countries to get civilians out of harm's way. I mean, I think it needed to be said by Israel, but it was also quite tactically clever too.
What does it tell you, Michael, these comments about the progress of negotiations as well?
Yeah, Annabelle, it looks like they've really stalled at this stage. I mean, last week there was a meeting in Cairo between the some heads of intelligence agencies and other senior officials from Qatar and Egypt and the US and Israel, and Israel's Prime Minister Netanyahu allowed his representatives to go to listen because he was suspicious that basically there hadn't been much change in Hamas's view, which was that Israel needs to withdraw from Gaza and that Hamas is allowed to, you know, stay in power there, which he finds is unacceptable. Now, after they'd been there for that first day, the talks then continued and Israel didn't return. And if one of the parties is not there, it's kind of like, you know, a three-wheeled car or a three-legged dog or something. It just isn't going to work. So I don't think we're seeing much progress there. And the comments from the Qatar official on the weekend suggested just as much, that we're really stalled at the moment. They're talking about humanitarian issues, but I just think that we're at an impasse there.
It feels almost like we're getting to a point of where serious discussions and wargaming is occurring on what happens if there is another Trump presidency. What does it mean for US, you know, international diplomacy and security? And it seems like a lot of these world leaders are maybe kind of gaming out situations where the US retreats from its usual protector status. Yeah,
we've actually got a really good story out on that from the Munich conference, and the sense is among European officials that they're really getting nervous about the US, and it's not just the Trump, you know, the possibility of Trump, it's just his influence on the Republican Party. I mean, the fact that that they couldn't release this $60 billion for Ukraine's now having to, you know, decide when it uses ammunition and when it doesn't use ammunition, and it just lost this city of Avdiivka on the weekend, and you know, the portents there are really not good. I mean, if the US can't get this aid through, it raises questions about its reliability as a partner. And a Trump administration, obviously, a lot of these Republicans are influenced by Mr. Trump. It raises all sorts of questions about whether Europe can rely on US support. Now, on one hand, that's important because Europe does need to step up. Countries like Germany do need to spend more on their defence. But on the other hand, you know, the US is the arsenal of democracy. It's so important for global stability. And I noticed even the German officials were saying, you know, there's a lot of economic importance to this relationship and this alliance as well that perhaps the Republicans aren't aware of. So, yeah, look, I think they're sort of worrying about what's coming.
Much has been said about the bravery of the Russian activist Alexei Navalny and the news of his death over the weekend. We saw President Biden putting the blame on Putin. What does his death tell you about what's going on within Russia?
Yeah, I mean, what Russia's always, under Putin, it's been authoritarian, and gradually over the, you know, it's 25 years now nearly he's been in power, it's gradually tightened and tightened and tightened. And once this war with Ukraine began, they basically used it as a you know, an inflection point where they weren't going to allow any protest whatsoever. Now, there was an attempt on Navalny's life a couple of years ago where he was poisoned and he was saved by an airline pilot who undertook an emergency landing, and they got him to hospital, and then he was flown to Germany and he survived. Now, he was warned that if he came back to Russia, he'd be arrested, and these Russian dissidents, they're a unique breed, really. He, despite having a wife and children, etc., he took the risk. He went back. He went straight out to Siberia, and he's been complaining about, you know, mistreatment and this sort of things. I mean, these are terrible conditions you live in there, and the idea of, you know, that Russians said he died of sudden death syndrome or something absurd, you know, like that. So yes, I mean, it's a tragic situation. Unfortunately, it was probably always going to be the likely conclusion.
Yeah, certainly a crushing blow to many Russians. That was Bloomberg's Michael Heath there. And returning back to the Munich Security Conference that Michael was just discussing, because Beijing at that event has called on Washington to lift sanctions on Chinese businesses and nationals. Chinese Foreign Minister Wang Yi made the appeal to the U.S. Secretary of State Antony Blinken on the sidelines.
Today, rejecting decoupling has become an international consensus. Those who attempt to shut China out in the name of de-risking will make a historical mistake. The ocean of the world economy cannot be cut back into isolated lakes. The trend towards economic globalization cannot be reversed.
For more, our Greater China senior executive editor John Liu joins us now in Hong Kong. And John, more talks perhaps between the US and China, but it still seems to be the same sort of sticking points.
So I think it's kind of a reiteration of China's position. Earlier in the show, you were talking about how there's this pessimistic mood looming over China. The relationship with the United States is a big part of that. You have the Trump tariffs that are still in place. You have now Trump threatening even more tariffs. You have all the sanctions on technology that have come in place under the Biden administration. Over the weekend, we got FDI data, or one measure of it, that was a 30-year low. So I think there is a real concern that there is a decoupling. It's happening for real, and there's no going back. And I think this is Wang Yi trying to push back against that, trying to, for the ultimate objective of Chinese diplomacy at this point is to get back to a better place with the United States.
How endangered or how, I guess, uncertain is that path, John, given the prospects of a potential another Trump presidency?
I think it's extremely uncertain, and to a certain point, China doesn't really have one candidate that it likes better than the other. I think either would spell more tough policies aimed at China, more limitations on Chinese access to technology. I think a Trump administration would entail more uncertainty because there is some continuity if Biden continues to stay in the White House. There would have to be a lot sort of more talks restarted, more discussions restarted under a new administration with Mr. Trump in the White House.
Our Greater China senior executive editor, John Liu there. Taking a look at another political story that we're tracking today, and the former Thai Prime Minister Thaksin Shinawatra has been freed from detention after being granted special parole due to his old age and illness. The 74-year-old was released 6 months before the end of his shortened jail term. Thaksin was sentenced to 8 years in jail on corruption charges after his return from a 15-year self-exile in August. We do have much more to come here on Daybreak Australia. This is Bloomberg.
You're watching Daybreak Australia, taking a look at how FX is trading, and you can see here fairly flat to start the week. We do have US markets that are shut Monday for a public holiday, so perhaps contributing a little bit to that thinner trading coming through. But the dynamics very much in focus as we kick off the week is really around synchronization among developed world central banks, because that is really starting to perhaps weaken given that domestic trends are starting to overtake global trends in determining price outlooks. So New Zealand, for instance, could be one of the first to continue hiking instead of cutting elsewhere. There's also the US, really traders starting to understand that the Fed has clearly pushed back on those expectations for cuts as well. The offshore yuan to notice, given it has weakened over the past few days of the Lunar New Year break. So we're tracking the onshore yuan once that starts trading in about 2 hours' time. But still ahead, we're going to be hearing from the Fortescue Executive Chair. That's Andrew Forrest joining us in the hours ahead. This is Bloomberg.
To finish the job will take fortitude. We will need to resist the temptation to act quickly when patience is needed and be prepared to respond agilely as the economy evolves.
That That was the San Francisco Fed President Mary Daly indicating an openness to 3 rate cuts this year should the inflation progress continue. But certainly what we've seen, those dynamics in markets over the past few weeks, has been that understanding that the Fed is really going to be perhaps in no rush to reduce their key benchmarks. So we had inflation reports still showing us that there is a certain level of stickiness, and that has been something that's been weighing or moving stocks and bond markets in turn. But here, the outlook for the day's trading session still come down to yes, those expectations for central banks. Also, earnings, a key one to note as well. And you've got the ASX 200 just moving a little bit high here as we get underway. Of course, US markets are shut Monday for a public holiday, so some thinner trading coming through. Japan setting up for losses. But again, Heidi, it is down to those reporting and the big numbers that are due in the days ahead.
Yeah, huge week, Belle, when it comes to Aussie miners, in particular BHP, Rio Tinto, Santos, among those reporting those latest numbers. Let's bring Bloomberg intelligence analyst Mohsen Crofts joins us now in Sydney. We're talking about, in particular, Thursday is going to be a very busy day. What are the highlights that you're kind of looking out for?
Yeah, absolutely. So first half of the week, we've got BHP, Rio and Fortescue reporting over the next few days. The iron ore space is really interesting. We've had obviously a much higher price than a lot of people expected. Particularly, that's going to benefit Rio Tinto, who has about 75% of their earnings from iron ore and has had pretty strong production numbers despite a slightly lower grade. BHP may find things a bit more challenging due to their met coal assets, so they did have much higher costs and weaker production. Later in the week, Thursday, as you mentioned in particular, we are looking at the three lithium miners, so IGO, Pilbara Minerals and Mineral Resources. They are all going to be struggling slightly from the much lower lithium price. And then we've got a couple of the gold producers as well. So, yeah, as you mentioned, very busy week.
Yeah, and then there's iron ore, because that has been doing very well. So what does it mean for the major producers?
Yeah, absolutely. So we're expecting, our global team is expecting about a 2% uplift in EBITDA for BHP. As I mentioned, the higher iron ore prices offset slightly by the met coal weak production numbers. They are also going to have the major write-downs. So their nickel assets, we're looking at about $5.4 billion in write-downs as a result of that much lower nickel price. And we're yet to see the impact on their decision-making from relief from the Australian government. Rio Tinto, we're seeing a 1.5 to 2.5 EBITDA uplift to 27 billion. Even though, as we mentioned, they didn't get the same level of grade, they did have a much higher shipment numbers. So overall, we think that should more than offset that and end up with a pretty good result.
You mentioned how challenging lithium pricing has been, and the likes of Albemarle has said they're unsustainably low. How much of a shake-up do we expect to see, or shake-out, I should say, when it comes to some of these assets? Yeah,
and it is an interesting question. I mean, we are already starting to see many of these global lithium producers now not being able to meet their costs. The good news for the Australian producers, particularly IGO and Pilbara Minerals, is these are among the lowest cost producers globally. So even though we are expecting, yes, lower margins because of the lower lower lithium price, spodumene now around the $850 per tonne mark, we think with their expansion of production, they are still going to be delivering pretty strong cash flows. Mineral Resources, slightly more challenging position because they are at around that marginal cost. So they will probably have to look at making some decisions at some point in the future as to how much they want to produce at these prices.
Gold miners, pretty tough run, but the metal price does seem to be improving. So where do they stand then?
Yeah, absolutely. Anyone invested in that gold mining space has had a pretty challenging couple of years. Even as we've seen the gold price rise over the past few months, the miners have not necessarily followed suit. So going forward, things looking pretty interesting. The margins are starting to look a bit better, we think, with higher realised prices. What is going to be critical for the miners is that they can show their ability to meet production targets. So both Newmont, which took over Newcrest's assets, and Evolution Mining have really been struggling a little bit to meet those expected numbers. Northern Star doing a little bit better. But we do think there's an opportunity now for them to have got their costs under under control and therefore to really benefit from the higher gold price. Gold price is really a question mark there, obviously. If we do see a situation where the Fed follows through with their cutting cycle and we don't get another major reversal of that, that could be a very positive sign for the gold market, and therefore we may be able to see some sustained improvement in the EBITDA for these gold miners.
Bloomberg's Mason Crofts are ahead of a very busy week when it comes to mining earnings. We'll be covering those numbers coming out of Australia this week. We'll also be hearing from the BHP CEO, Mark Henry, on Tuesday. Staying with the Aussie miners, Fortescue's founder, Andrew Forrest, says a leadership exodus at the company is a natural progression. Fortescue has been hit by a number of senior departures over the past 6 months, highlighting concerns around Forrest's leadership style.
Really great people in place, two great chief executives of metals and energy. They are making those are decisions. By the way, they employ 22,000 people. You talk about 6. I mean, we have up and coming people, younger people, cross-gender, who really deserve to be given those positions of responsibility. Good people such as the person you just mentioned out of Europe recognise that and decide to step aside, move on after mentoring those people. So I look at it as I've been told, a natural and very healthy progression of a very large company. I think it's a complete storm in a teacup. You look at the board of directors, you look at the people who have built this company. We've been there for 15 or 20 years.
So Twiggy, is it fair to say then nothing to see here? You don't need to change anything at this moment, that you're comfortable with the way the leadership is structured, even if you have seen those departures?
Yeah, look, if we didn't have this dynamism where we are changing the company for what it must be to meet all the future challenges of our world, to be the green energy, green metals, green technical solutions company, green electricity solutions company, then we must continue upskilling, we must continue changing, we must continue maximising gender,
Twiggy, I got to jump in because we're running out of time
and that
here.
means that people are stepping on.
And I want to ask about China, because obviously this is a big issue for the metals market. There's a concern about a glut. Construction season begins in March. Do you think the fiscal stimulus we've seen is enough to counteract some of the weakness in the economy? And apologies, only a minute here, Twiggy.
Okay, if you're asking me, should we be worried about critical minerals when there's a glut of critical minerals, the price is right down? I would say what we need to be worried about is diversifying your markets, and you'll do that if you insist on high standard of human rights right here in Europe with the Corporate Responsibility Directive. If you insist on environmental practices which are up there with the best in the world, even deep sea mining is a complete joke if you don't do the longitudinal environmental and ecological studies which we do on land, and of course going green. These are the 3 parameters which, if you insist on in Europe, North America, Australia, you'll have a much more diversified supply chain. And you won't have a glut of one supplier swapping out and swamping everyone else.
That was the Fortescue Executive Chairman and Founder Andrew Forrest speaking with Bloomberg's Danny Berger. And up next, we'll hear from the CEO of AnyChange as Japan's biggest provider of electric car chargers on the country's transition to EVs, which is still in the pretty early stages. We'll have more next. This is Bloomberg. Well, it's time for Japan Ahead on Daybreak. Australia and core machine orders for December are due in the next few minutes. Economists expect the figures to rise to 2.7% month on month. That's after falling 4.9% in November. You can also keep an eye on shares of Mitsubishi Heavy when market opens in just a few minutes' time, about 20 minutes, following the successful launch of Japan's flagship rocket. That's after a failed attempt last year. Plus, we're still watching the benchmark Nikkei 225 index, which is within sight of a historic high reached in December 1989.
Japanese markets to open at the top of the next hour, and of course pretty quiet in terms of the lead from the US, a public holiday there of course for this weekend, but we did have a little bit more of an attempt, if you will, to get back to those record highs, although eventually the S&P 500 closing just shy of that. We had the stronger than expected PPI reading, just consolidating this repricing of the reining in of Fed rate cut expectations. Dollar yen is holding pretty steady, but again above that 150 level. We're on alert for intervention-esque, I guess, or adjacent comments from policymakers at these levels. Singapore Nikkei futures are trading a little bit softer, about 0.6% lower there. A bit of a mixed start for Asia more broadly after that slump on Wall Street. And of course, the big news is really Chinese stocks poised for a strong open. But of course, Japan has had a pretty strong start, and equity strategists are rushing to raise the year-end forecast for the Nikkei 225. It's edging closer to that 1989 high. For more, let's bring our Asia equities reporter, Winnie Su, who joins us in Tokyo. So where are these analysts seeing the market end by the end of this year? And of course, we have been sort of tracking this steady drumbeat towards that December 1989 high. Not quite there yet, though.
Yeah, exactly. I think the recent rally really caught a lot of strategists by surprise. And we saw, just in the past couple weeks that Wall Street banks from JP Morgan, Morgan Stanley, Citi, and also Bank of America raising their targets for both the Nikkei and the topics. And even recently, domestic investors, we saw Nomura and also Daiwa raising their targets. And some now say that by the end of 2024, the Nikkei is likely to rise to over 40,000. So that is quite a milestone for Japanese stocks, really saying something about how strategists believe or think that this rally is very likely to continue with the momentum. And they are actually citing all different types of catalysts, which is something quite interesting. Some say that it's really driven by, some more improvements that we're going to see in the earnings. But others say that, it might be the strong U.S. market demand, and also how the Bank of Japan maintaining that easing monetary policy is going to help the yen to stay weak and hence helpful for the Japanese market.
Is there anything that, though, could really test this optimism around Japanese equities? Right. So I think speaking of that risk, I guess from a technical perspective, people are seeing some overheat in the market. And also, like you mentioned, the U.S. PPI numbers came stronger than expected. So people's concern around how the U.S. market, how the Fed's cut might come later than expected, that might weigh on sentiment. But at the same time, when it comes to the Bank of Japan, the change of the monetary policy might be slightly negative for the Japanese stocks at the beginning if we expect rising rates to weigh on equities. But overall, if we think that the Bank of Japan's change is going to be gradual, the yen, even if it appreciates, it's still probably going to stay at a weak enough level to support Japanese equities going forward. And when we look at the flow perspective, we've seen foreign investors buying Japanese stocks for 6 weeks straight already. So you would think that, people would start taking profits after a strong rally. But that continuous flow also is quite supportive for the market's sentiment. And we see that a lot of the global funds are still maintaining that underweight around Japanese equities. So when that flips, we can probably expect more funds to flow into the market going forward. That was our Asia equities reporter, Winnie Su, there in Tokyo. And let's stick in Japan because car makers are keeping their foot on the pedal when it comes to investing in electric vehicles. And that's despite a slowdown in sales. Nissan says the EV shift won't happen in a straight line, but long-term growth is still expected. Subaru also says the company factored in the possibility that the EV market will reach a growth plateau when formulating its $10 billion investment plan for electrification. Well, our next guest runs Japan's biggest provider of electric car chargers, and they're urging the government to mandate priority parking spaces for EVs. Let's discuss now with the CEO at AnyChange, that's Yohei Kaiguchi, joining us this morning. And Yohei, just talk us through this request that you're making to the government. It does seem to at least stem from a low level of EV ownership in Japan.
Thank you for having me. It's a great pleasure to be here with you. Yes, the EV charging infrastructure in Japan is still small and slow. Only 4% of the market share for EV and plug-in hybrid in Japan, which is the lowest among the G7 nations. The Europe for 25% and America for 10%. In the EV charging infrastructure, there are 40,000 EV charging stations in Japan, with average speed of 3 kilowatt for normal charging and 40 kilowatt for fast charging, which is also very slow and small. The Japanese government set a plan to install 300,000 charging ports with a tripled charging speed by 2030, and to achieve the $1 trillion USD stimulus plan in private and public funding is also announced. There are 3 key players in the EV charging market in Japan. Ourselves, AnyChange, is a dominant player in destination and apartment charging with a 60% of the market share. The one large electric company is specializing in the fast charging, and the large petrol station company is also expanding a fast charging network.
So, Yohei, when it comes to designing charging infrastructure, though, what sort of measures need to be taken to really capture Japan's unique situation in this perspective?
Yeah, it's a tough question, but it's a great opportunity for Japan to regain the momentum, to catch up with the international counterpart in the EV race. The Japanese automaker set to introduce a wide range of electric vehicles from 2026 onwards. The recent downturn in the EV sales internationally provides then a great opportunity to bridge the gap with the international counterpart. Therefore, I think the Japanese auto industry will be well positioned to flourish in the EV race by 2030.
Yohei, if you take a look at other markets around the world, is there one that you see as something that Japan should emulate, and what sort of government policy would be required?
Sure. The Japanese government plan of like $1 trillion stimulus plan for green transformation is very competitive against the similar plans by the USA IRA and like European plans. So Japan's government is already decided to match up with America and Europe for the green transformation. So the plan is there, and actually the next thing is execution. Like all the companies and entrepreneurs needs to realize push the green transformations in Japan.
Yohei, I wanted to ask a question. Obviously, Japanese markets are very much back in favour now. What are the aspirations for AnyChange from here in terms of fundraising and progress for its market listing? And how do you see, I guess, the broader macroeconomic environment impacting you?
Great. Thank you for asking me. So we actually call it Project Anycom, the drive to make AnyChange over $1 billion market cap. Last week, AnyChange announced a $30 million USD fundraising from JIC at Sovereign Wealth Government Fund. With this fund, AnyChange should be able to capture even larger market share in the EV charging network. The government is envisioning to generate more unicorns from Japan. There are over 500 listed startups below $1 billion USD market cap at the Tokyo Stock Exchange, and AnyChange is one of them. So the recent 30 million investment from the government fund to energy is a clear illustration of the government commitment to make us a billion-dollar market cap project Enecom.
That's Yohei Kikuchi there, CEO at AnyChange, joining us, and just drawing your attention as well to some lines that are crossing the terminal, which is Japan core machine orders, and we're getting those readings for the December period here. Month on month, we actually saw an increase of 2.7%, so that just reversed the trend prior of a contraction of 4.9%. Year on year as well, the number coming in a bit better than what had been expected because the survey was for a contraction of 1.3%. The actual reading came in at negative 0.7%. And again, it is that trend of improvement because in the month prior it was a contraction of 5% here. So again, those numbers for core machine orders, it's an indication of the health of Japan's economy and telling us that they're coming in a bit better than what had been expected, at least on the year-on-year reading. You can catch Japan Ahead every week. That's every Monday at 8:40 a.m. if you're watching in Tokyo, 7:40 p.m. Sunday in New York, and Bloomberg subscribers can watch us live on the terminal using the TV Go function. This is Bloomberg.
Take a look at the latest corporate stories that we're following this hour. And Apple is set to face an EU fine of over $530 million over allegations it silenced music streaming rivals like Spotify on its platforms. Sources say the penalty will be set after the EU watchdog found it fell foul of competition rules in thwarting rival music services from informing users that cheaper alternatives existed outside of its app store. BYD is launching more high-end luxury models this year in order to achieve a leading position in the market. The automaker plans come after authorities urged listed companies to improve their quality and investment value. BYD is also formulating a share repurchase plan based on market conditions. Bloomberg has learned that Nintendo is delaying the release of its next console to early 2025. The successor to the popular Switch was targeted for release this year, and our sources say Nintendo expects the device to come out in March 2025 at the earliest, missing that key holiday shopping period. The Switch is now 7 years old, with Nintendo selling over 139 million units.
Yeah, Nintendo, one of the companies they're going to be watching at the start of trade here, but we do have Japanese equities actually setting up for a weaker day of trading here. Futures down around 0.5%. That's the Osaka contract, one of the most liquid ones. Still, though, broadly, we have seen equity strategists rushing to raise their forecast for the Nikkei 225, and we are getting closer to that record high that was set in 1989. But we'll have the market opens in Tokyo and Seoul. Those are next. This is Bloomberg.